Hi, this is Lara at Elliott Wave Stock Market with your extra video update after the session Tuesday 17th of May has ended. Yesterday the main wave count was swapped over and it expected more downward movement. That's what we've got. I'm still expecting that's most likely we're going to see downward movement accelerate. It's most likely a third wave down is underway and approaching the middle. The short-term target is 1988. The long-term target, which is the same for both hourly wave counts, remains at 1423. An alternate survives, so the risk has to remain mid-term at this stage at 2111.05. Let's have a look at the weekly chart. Actually, let's make that a little bit bigger first. This should be better. Yeah. So at the weekly chart level, the main wave count is very bearish. To see how this fits into the bigger picture, going back to the 1800s, have a look at the grand supercycle analysis. It's linked to every day in the text article, and you'll find it on the right-hand sidebar under categories of the website under S&P 500 Historic. This is a very bearish wave count. It expects a huge bear market that has no lower limit, no lower invalidation point. It's most likely to be a grand supercycle, a supercycle C wave, which is most likely to be an impulse, but it could also be a huge flat or a triangle for a supercycle Y wave. It begins here and it should last several years. It should start with a clear 5 down at the monthly chart level. We don't have that yet. We probably have an impulse for primary 1 and a running flat for primary 2. I had expected intermediate C to move slightly beyond the end of A to avoid a truncation and a very rare running flat, but it failed to do that. It completed the structure, falling just over 5 points short of the end of intermediate A. The truncation is relatively small for these big waves, and so it is acceptable, and the type of situation you may expect to see a running flat turn up in might be just before a very strong third wave, and a primary degree third wave within a bear market to the downside is exactly a very strong third wave. Its target is 1423, where where it would reach 2.618, the orthodox length of primary wave 1. That's the appropriate ratio for that target, because primary 2 is so very deep, it's over 0.9 the length of primary 1. Primary 1 subdivides nicely as a 5-1 combination for 2, impulse for 3, zigzag for 4, and a fifth wave which is slightly truncated. Again, that truncation is acceptable. It comes after a movement that fits the definition of too far too fast. This third wave was a sheer drop downward. Very importantly, this bear market wave count sees this downward movement from this high to this low, subdividing as a 3-wave zigzag. It subdivides 5, 3, 5, and the C wave fits perfectly 1, 2, 3, 4, 5. The bull wave count has a big problem in terms of subdivisions for this piece of movement. I can't get it to fit and make sense. Let's have a look at the start of primary wave 3 at the daily chart level, where primary 2 ends up here, and I'm copying over these trend lines from the weekly chart. This bear market trend line may continue to be very important. If upward movement breaks above this short-term line, then this should be where upward movement finds final, very strong resistance. I would not expect for the bear count for that line to be breached again. We had drawn a channel around intermediate C and it was breached back here, telling us that this upward wave was over and the next wave was underway. We have a 5-wave structure to the downside, a 3-wave structure to the upside, so we should be expecting more downward movement as most likely. Within minor 3 we have 1, 2, we need a third wave. Within a third wave, this is still only within intermediate wave 1 of minor 3. When intermediate wave 1 is a complete 5-wave impulse, we'll be expecting a multi-week correction, a bounce, another dead cat bounce for intermediate wave 2. I would at that stage probably expect it to find pretty strong resistance and maybe end, if it's deep enough, at this short-term bear market trend line, but that's quite a way away yet. For the short term, this wave count's expecting an acceleration to the downside, some strong red daily candlesticks as a third wave of a third wave begins lower. I still have an alternate looking at the possibility that minor 2 is not over here, that it's continuing even further sideways. That remains possible. It can't move beyond the start of 1 above 2111.05, and that right there is exactly why I say risk to short positions must remain this invalidation point at this stage. Let's have a look at the first preferred hourly wave count. We're minor 1. Is this slow down here? Minor 2 is very close to the 0.618 Fibonacci ratio of minor 1, and it subdivides perfectly as a zigzag. It's reasonably likely that it's over here. Within minor 3 we have an impulse for minute 1. A 335 expanded flat correction for minute 2 is most likely over here. This may be where minute wave 3 begins. At 1988 it would reach 1.618, the length of minute wave 1. Within minute wave 3 I expect its first wave may complete early in tomorrow's session. It may end when downward movement finds support at the lower edge of the base channel about minute waves 1 and 2. There are a few trend lines on this chart cluttering up the place, but they are really important. This is the bear market trend line copied over from weekly and daily charts, and here's the short-term bear market trend line. This cyan line here is going to be really important on the hourly chart tomorrow. But first, this pink trend channel is a base channel drawn around minute waves 1 and 2. Draw a base channel from the start of the first wave to the end of the second wave, and then place a parallel copy on the end of the first wave. Along the way down, lower degree corrections should find strong resistance at the upper edge of this base channel. If this trend line is breached, then upward movement tomorrow should find very strong resistance at the short-term bear market trend line. We'll look for resistance at the pink line in the first instance. I am expecting a little fourth wave correction to complete shortly, and then a short little fifth wave down, maybe early in tomorrow's session to make a new low. That would complete a 5-wave impulse down, which would be minuet 1 within the impulse of minute 3. When minuet 1 is complete, we'll draw a Fibonacci retracement along its length. We'll look for a short lasting bounce. If it's deep, to find resistance at this pink trend line. It doesn't have to be that deep though, and it can't move beyond the start of 1 above 2071.88. Targets for minor 3 are midterm targets. The first target at 1969 for it to reach 1.618, the length of minor 1. If when we get to this first target the structure of minor 3 is incomplete, or if price just keeps on falling through that first target, then we'll use the second target. At 1897 minor 3 would reach 2.618, the length of minor 1. For all of my targets, as we get closer to them and the structure becomes complete, as we get quite close, I'll be able to calculate targets at more wave degrees, and so they'll often change close to the end or widen to a small zone as I try to narrow in on the most accurate target I can calculate for you. Let's have a look at an alternate where minor 1 is still over here, so this is identical, and we're still seeing all the subdivisions in exactly the same way. A zigzag up and now a 535 structure to the downside. But if we move the degree of labelling here back down 1 degree, this could be A, where the zigzag down could be B, and then we could have C up for a regular or expanded flat correction for minor wave 2. This alternate with some adjustment from yesterday does still survive. Expanded flats are really common structures, and second wave corrections, particularly early in a bear market, can be rather deep and time consuming. They don't have to be, they just aren't always deep and time consuming, but we should look out for it to sometimes turn out like that, and the correct way to do Elliott wave analysis is always to consider alternates, so that if your main wave count is invalidated, you have an alternate explanation and a roadmap to use for what should happen next. This is the very important trend line for tomorrow. We are expecting a bounce tomorrow for the main wave count. Now that should find strong resistance at this green line, which is exactly the same as the pink channel on the main hourly chart. Here, this channel is correctly termed a corrective channel around this 535 zigzag unfolding downward. When this corrective channel around minute wave B is breached very clearly by upward movement, it would be telling us that this wave is over and the next wave to the upside then is underway. If this trend line is clearly breached tomorrow or the day after, then I would expect upward movement should continue and probably not end until price comes up to touch this bear market trend line. And this is exactly why risk remains at 2111.05. This wave count remains viable. It is not my preferred wave count. Based on volume analysis, I expect the main wave count is more likely. This is a what if. What if the main count is wrong? If we get a breach of this channel, then after that we will have full price confirmation of this idea with a new high above 2071.88, as that would invalidate the main wave count. To the downside, minute wave B may be a B wave with an irregular or expanded flat, and the common length for a B wave within a flat is from 1 to 1.38, the length of the A wave, giving us a range of 2039.45 to 2022.19. There is no Elliott wave rule stating a maximum limit for a B wave within a flat, but there is an Elliott wave convention that says when your potential B wave reaches twice the length of the potential A wave, then the idea of a flat should be discarded due to a very low probability. That price point in this instance would be 1994, so if price moves below that point, this idea or any variation of it would be discarded. I would probably in practice discard it quite a lot longer before this price point is passed. If that dark blue base channel in the main hourly chart is breached to the downside, I'll be discarding any alternate that sees minor 2 continuing. This is entirely possible. We could see a multi-day bounce up to end above 2084.87, so that minute C moves beyond the end of A, avoiding a truncation, and up to the bear market trend line, but not above this invalidation point. At the daily chart level, this is the bull wave count, and I've gone over this in some detail in the last end of week video. I don't want to make this video too long, so I'm not going to spend too much time on this. Suffice to say, I don't have any confidence in it. There is little to no support from classic technical analysis, and in terms of Elliott wave structure, it has a really big problem. Here's the big problem from here to here. We have to see this as a 5. We have to see primary C as a 5. It subdivides 1, 2, 3, 4, 5. As you can see, the third wave has a strong 3-wave look. The bear wave count doesn't have that problem. This substantially reduces the probability of this alternate. And I'm not going to spend any more time on the daily chart there. Suffice to say, it too, at least short term, is expecting downward movement. Let's have a look at some classic technical analysis now, starting off with a weekly chart for you. We've got a bearish engulfing candlestick pattern for these 2 weeks here. It's come at the round number pivot around 2100. It's found resistance at this bear market trend line. And we have heavier volume on the bearish candlestick than we do on the bullish candlestick from the first weekly candlestick, and so that all supports the reversal implications of that bearish engulfing pattern, which is the strongest reversal candlestick pattern. And the only slight concern here is that for these 3 weeks in a row, these 3 downward weeks, it's coming overall on declining volume. It's only of a slight concern because the market can fall of its own weight. We don't need an increase in sellers for price to fall. An absence of buyers will achieve the same outcome, which is why we say the market can fall of its own weight. That might be what's happening here. At the weekly chart level, ADX is still declining, indicating no current trend. ATR at the weekly chart level is in agreement. On balance volume gave us a strong a strong bearish signal here at the weekly chart level when it breached this purple trend line. It's been tested a couple of times before, and now it's been breached to the downside. So that's a reasonable bearish signal from on balance volume, which I give quite a lot of weight to because it tends to work quite nicely with trend lines. Let's have a look at the daily chart. So for some classic technical analysis. At the high back up here, let's try and make that a little bit bigger. That's a bit small. That's better. At the high up in here, we've got an evening doji star candlestick pattern. Now again, we've got stronger volume on the downward candlestick than we do on the upward candlestick, and we've got a nice doji for the middle of it, so it's an evening doji star, and that is a reasonably, well, not necessarily reliable, but it's a reasonable reversal candlestick pattern. We have also a head and shoulders pattern here. Here's the head, the left hand shoulder, the right hand shoulder, and here's the neckline, which is today providing support for downward movement. Now it's not really very clear that there's lighter volume on the left shoulder than there is on the right shoulder, but the stronger volume is to the right of the head, particularly these two downward days. So there's just a little bit of support for this from volume, but it's not as clear as I would like it. I would have liked to see stronger volume on the right hand shoulder over here, but this volume's a bit lighter. If price breaks below this neckline in the next day, and price is finding strong support there, which is this line's previously provided strong support and resistance, then the head and shoulders pattern would be confirmed, and a target would be for price to continue down about the same distance from the head to the neckline to the downside. That target, I think I've calculated it out, at about 1994. If price manages to break below support at these lines tomorrow, and it does so on a downward day with an increase in volume, that would be a strong confirmation of this pattern, and we should be expecting more downward movement. We've got some downward movement today, which is what we'd expected, and importantly it's shown a nice increase in volume, so we've got some support for this fall in price, which is nice to see for the main wave count. That supports the main hourly wave count over the alternate. The other thing that supports it, and the reason why it's my main wave count, is prices finding resistance at this sloping trend line here, and this is the same as my short-term bear market trend line and my daily and main hourly Elliott wave counts. Because price is finding resistance here and falling prices coming on stronger or increasing volume, that's my main wave count. Those are the two reasons why I prefer it. I want to see a break below support about 2040 and below this neckline in order to have really good confidence in that downward movement that I'm expecting. Today, ADX and ATR are disagreeing. These two trending indicators will often disagree in the early stages of a new trend. ADX is flat, telling us the market's not trending. It doesn't tell us there's a trend change though. The negative DX line remains above the positive. ATR is disagreeing because it's increasing. That indicates we might be seeing the beginning of a new downward trend. On balance, volume gave a bearish signal here and here when it broke below the yellow line and retested it. It strengthened that yellow line when it again retested it, another bearish signal. It gave a slight bullish signal here when it bounced up from the purple line. It's come back down to the purple line, so how on balance volume behaves tomorrow is going to be really important. On balance volume does tend to work very well indeed with trend lines. If this trend line is breached, then it would be a strong bearish signal. It's a strong signal because the trend line has substantial technical significance. It's essentially horizontal, it's fairly long held, and it's been repeatedly tested. That's why it has strong technical significance. A break below the pink line would be a further bearish signal. A break below the green line would be a further bearish signal, but I might discard this pink line in the next couple of days because it's not going to be particularly useful. It's coming up to converge with the purple. RSI is pretty close to neutral, plenty of room for price to rise or fall. It's not indicating overbought or oversold. Stochastics still not extreme, and if in a trending market I wouldn't expect that one to be of much use. I'll look for a divergence there. Let's have a look at VIX. There's nothing really to tell us in VIX what's going to happen next. I would look for divergence short term with price and VIX to indicate any weakness. There is no weakness to this downwards movement, and so I guess that's a little bit of support for the main hourly wave count, but not really. What is support here for a bearish outlook though is this very long held and substantial divergence between this high back in November last year and this high back in April this year. VIX, inverted VIX that is, made new highs, but price failed to make corresponding highs even if we look at this point in price. And so as VIX made new inverted VIX made new highs, volatility was declining, but that decline in volatility was not able to be translated into a corresponding rise in price. That tells us that price was weak. That's hidden bearish divergence. We've got it again here. VIX inverted, made a new high. Price failed to make a corresponding new high. Again, shorter term now, weakness in price. The advanced decline line also shows that hidden bearish divergence. The advance in price here was supported by breadth. More stocks were advancing than declining, but the advanced decline line made a new high beyond this prior high back in November, where price failed to make corresponding highs. So despite breadth to upward movement, it couldn't translate to corresponding rises in price. This upward movement in price was weak. The advanced decline line has breached a trend line. It's moving away and sideways so far, not really lower. Price has overall been moving sideways as well for about 11 days now. It's fairly range bound. I'd be expecting a breakout probably tomorrow. I'm not going to go over these figures for the last bear market, but in the last bear market, let's look at the primary degree third wave, and let's have a look at what happened with the first couple of smaller second wave corrections. Now, no matter what degree I label this, we have a second wave correction here and a second wave correction here. This one lasted just 2 days compared to 5 days of overall downward movement for the first wave it was correcting, and this one was, I think, 0.49 the depth of the first wave. So it was a relatively brief and slightly on the shallow side second wave correction. This one also lasted 2 days, and it was a relatively deep correction. This little first wave lasted just 3 days. This second wave lasted 2 days, so not as long as, but pretty close to the first wave it corrected, and it's 0.94 the depth of the first wave, so it's more time consuming and it's very deep. What that tells us is there really aren't any rules as to how second wave corrections early on in a primary degree third wave bear market for the S&P should behave. Looking back at this last big bear market, this is the big bear market from 2007 to 2009. So looking back at this, we can't say with certainty how the second wave correction from 1 or 2 that we're currently looking at should behave. It could be brief and shallow, it could be deeper, it could be very deep indeed. So we have to be flexible and use alternates, which is absolutely why I'm always going to try and publish an alternate for you. That's all for me today with your S&P analysis, and I hope all of our members are having a fabulous week.